Okay, Kende, you are welcome to class. I'm making you my co-host.
Thank you, sir.
So, as usual now, once I'm logged out, you guys should take charge. Okay, so welcome back to our second series of the topic taxation of specialized businesses. Yesterday, we started the topic and we were able to, we look at some definition of terms as it relates to specialized businesses. Then we discuss the tax provisions for real estate companies and real estate investment companies that are approved by the Securities and Exchange Commission, SEC, under the relevant provisions of real estate investment scheme. If you can still remember, under this, we discussed the provision of Section 19 of CETA. Can you still remember the subsection 1 and subsection 2 of CETA? We look at the various exemptions that are available for companies in real estate, especially those that are duly registered and approved by the Securities and Exchange Commission under the relevant provisions of the real estate investment schemes. We also discussed the provision of Section 23, and also we discussed the provision of Section 8 as regards the as regards the 75% dividend distribution. Okay, so for companies to qualify for this exemption, then the company must at least have distributed nothing less than 75% of its dividend received or rental income received during the period. So apart from that, what else did we discuss under the real estate? Mary, you were in class yesterday. So what are the things we discussed? We discussed the various tax applicable to company in the real estate, such as the company income tax, withholding tax, tertiary education tax, value tax, land use charge, and stamp duty. Then what else did we discuss? Okay, so also we look at Section 24. We discussed Section 24 of CETA as amended through the Finance Act of 2020 and 2019 and 2020. So under the Section 24, we discussed the mandatory distributions. So that is, if the company did not meet up with the requirements of the Section 23, subsection 1, okay, then it will not qualify for the exemption. And any expenses incurred in generating tax exempt item, okay, so shall not be allowed as a deduction in computing the company's assessable profit. So Section 23 is about the exemption of the 75%, of dividend income and rental income from tax, while Section 24 is on the expenses relating to those income that are tax exempt. Then also we discussed the tax provisions relating to the agricultural business and primary agricultural production. Under this, we look at the pioneer status available for small and medium-sized companies in the business of agriculture. And these, for the initial period, we mentioned that it is 4 years, and for 2 additional years, based on the satisfaction of the ministry. So in total, it's like 6 years. Okay. So then also we discussed the taxation of foreign air and sea transport companies, as well as the taxation of foreign companies engaged in cable undertakings. So remember that these companies do not pay, this company doesn't pay education tax. So they don't pay what? They don't pay education tax. And remember, we mentioned that the minimum tax they pay is what? The tax they pay will not be less than 2% of the income derived from Nigeria. It should not be less than 2%. of the income derived from Nigeria. So in today's class, we'll be looking at the taxation of banks, taxation of insurance business, taxation of unit trust schemes, then the circumstances when the revenue can assess a company based on its gross turnover. And then we will, if time permits us, we look at the taxation of enterprises in the free trade zones. Taxation of enterprises in the free trade zones. Are we together? Hello? Hello? Hello, are you guys there?
Yes, sir. We're here.
Yeah, talking now. Is the class board?
Kind of.
Kind of bored. Ah. Should I allow you to go and sleep and come back in the next 30 minutes?
No, sir. No, sir. We can continue the class, sir.
Yeah, don't let it be bored. It's because you guys are not talking now. Or is it me that is making the class bored?
Not at all, sir.
Okay. So, if time permits us, we'll be taking like 6 subtopics in today's class. So to start with, we are taking the taxation of banks. Okay, so yesterday we discussed the taxation of foreign company engaged in cable undertaking. So I'm not taking my time to take you guys through that again. So in fact, I'm giving another assignment. You guys are here to submit the assignment for yesterday's class. So I'm adding another one to it. If you like, you don't submit again. I'll keep adding to your assignments until I'm satisfied. Okay, so go and practice this one too. It's similar to that of yesterday, ultimately limited. So go and practice it. So make into an assignment on this topic. So taxation of banks. Banks, like other financial institutions, are not exempted from the payment of tax. So what are the other financial institutions? Apart from banks, what are the other financial institutions that you know? Hello? Mary Ogeneshuko Kende. Apart from banks, what are the other financial institutions that you know?
I think agric and producing companies. Agricultural producing companies.
Agricultural business, or what are you saying?
Insurance company.
Yes,
Insurance
sir.
company. Okay. You've forgotten that we have microfinance. We have fintech. etc. So these companies are not exempted from the payment of companies' income tax. And based on this, banks are subject to tax in the same way and manner with which other incorporated companies are subject to tax. So it is important to state that they are also liable to companies' income tax, stamp duties, value-added tax, personal income tax, capital gains tax, what else? Among others. Okay, so banks are required to file both monthly and annual tax returns. In fact, in addition to the normal VAT filing, paying, company income tax returns, among others. You see, banks do file, in fact, before the amendment through the Finance Act of 20, 21, I think. Okay, so they used to fight for the list of new customers. Okay, so they fight for the list of new customers on a monthly basis. But now it has been extended to maybe every quarter. So now they do that every quarter. So banks are required to file both monthly and annual tax returns. Failing which such returns will constitute a violation of the applicable law and would attract penalties. So let's determine, or how do we determine the assessable profit and tax liability of banks? Remember, they are subject to tax in the same way and manner other companies, are subject to tax or liable to tax. So the only difference here is that, like for instance, the manufacturing company, their revenue will always be from sales of goods, but for banks, their revenue will always be interest income. Okay, so their major revenue will be interest income. Then we have the bank charges and the likes. So banks are liable to tax under the provision of the company income tax, and they are subject to tax in the like manner. But there are some specific provisions that are somewhat peculiar to banks, and these include: one, the interest on loan granted by banks to a customer for manufacturing goods for export. You see, the interest on this interest on loan to these to companies in the manufacturing industry whose focus is on what? Is on export. Okay, so all the goods they manufactured are for export. So the interest income shall be exempted from tax as provided under the Table 2, Schedule 3 of the CETA as amended and subject to the following conditions. One, the beneficiary company must export not less than 50% of its manufactured goods sold, and such goods must not be exported back to Nigeria. So if Ogeneshuko Limited is into the production of snails, okay, so, and she's into snail farming, and she exported all, okay, that's agricultural business. Let me use manufacturing business. Let's say she's into the production of bags. Nigerian bags, Aba made. Okay, so, and she has, approached Zenith Bank for loan, and she was granted the loan. So if Zenith Bank can prove it that Ogeneshuko Limited, exported at least or more than 50% of its manufactured goods, and those goods were not re-exported back to Nigeria, then the bank will qualify for exemption on that interest. Another thing is that the beneficiary must, obtain a certificate of export issued by the Nigerian Export Promotion Council, certifying the export of the company. Because it's not possible for you to be exporting from the country to another country without you getting approval or obtaining a certificate of export from the Nigerian Export Promotion Council, NEPC. So, except you are taking it through, the land border, and probably you are using all these, what do they call them? All these guys, smugglers. They are using the smugglers, to smuggle the goods out of the country, which is prohibited by law. So that's number one thing. Now, we have the Table 2 mentioned. Okay, this is the Table 2 mentioned. I think we've done something similar to this. Have we? Hello?
Yes, sir.
We've done something similar to this, Abby. Why taking you on the
Yes.
exemption of interest, Abby?
Yes.
So Table 2, Schedule 3 of CETA 2004, the loan that has 7 years repayment period with a grace period of not less than 2 years has a tax exemption of 70%. And the one between 5 to 7 years with a grace period of 18 months has tax exemption of 40%. So if the interest is 100 million naira, okay, then we are exempting 40%. So it means that 40% out of the 100 million naira will not be subject to tax, which is equivalent of 40 million naira. Then the next one is the interest on loan granted by bank for primary agricultural production. If at least 12 months moratorium period is allowed and the rate of interest is not more than the base lending rate of the bank at the time the loan was granted, refinanced, or otherwise restructured. And remember, yesterday we defined what primary agricultural production is, and it is into 4 stages. We have the primary crop production, we have the primary livestock production, we have the primary forestry production, and then we have the primary fishing production. Please take note of all this. Then also interest on loan granted by bank to a company engaged in the fabrication of local plants, machinery, and tools shall be exempted from tax if at least 12 months moratorium period is allowed and the rate of interest is no more than the base lending rates of the bank as at the time the loan was granted, refinanced, or otherwise restructured. Mary, you read D for us. Mary.
Hello, sir. Can you hear me, sir?
Yes, ma'am.
Okay, interest on loan granted by bank to companies in the corrugate industry under the Family Economic Advancement Program shall be exempted from tax if at least 12 months moratorium is allowed and the rate of interest is not more than the base lending rate at the time the loan was granted, financed, or restructured.
So now we have 3 different, companies, category of companies in different industries, that are allowed this exemption, in as much that the loan has a moratorium period of not less than 12 months, and the interest rate is not more than the base lending rate of the bank as at the time the loan was granted, refinanced. And these companies are one, companies into an agricultural business, into agricultural business. Another one is company engaged in fabrication of plants, and the last one is companies engaged in the cottage industry. Yesterday, I explained what cottage industry is now. Abby, Kende, I did explain what cottage industry is in our yesterday's class. Hello.
You
can't remember, Abby? So what is cottage business? So a cottage industry is a small manufacturing business. I mentioned it yesterday using Mary as the reference that she owns and operates an individual or family business. So this business is typically operating, out of a home rather than a purpose-built facility. So, and another a good example is she's a caterer, okay, and she makes cakes for her family, okay. She produces cakes, bread, and the likes just for her family and not for commercial purpose. So it's just like having a startup, okay, having a startup. So gradually she extended it to the neighbor, okay, so selling just only to the neighbor, okay, and she's not selling to the whole community. Okay, so gradually she advanced, she graduated to the community level. So by the time she moved to the whole local government, then she's no longer a cottage business. Do you understand? So, because she used the member of the family are the labor, okay, And materials for such a setup of production are mostly locally sourced. So she's not importing anything, you know, the labor is her family and the likes. So that's it. So another exemption for banks is interest received by banks on the federal and state government development loan stocks or bonds. They are exempted from what? They are exempted from tax. Then interest earned on foreign placement or dividend, rent, and royalty derived by any company from outside Nigeria and brought into Nigeria in convertible currency through a domiciliary account in a bank approved by the government. Then dividend treated as frank investment income. So when banks too receive dividend, and the dividend is, or qualifies under the definition of frank investment income, that is, tax has been deducted at source, then it will also be exempted. So also in banks, the following expenses or provisions are not allowed. One, increase in provisions on performing loan accounts. So the performing loan accounts is in line with the provision of the prudential guideline. CBN prudential guideline. Okay, so the classification, I think for performing loan, it's 1% of the loan portfolio. Then for the non-performing loans, we have that is split into three. One is 10%, and then another one is 50%. But when the loan is bad, that's 100%. I think doubtful is 50%, doubtful is 50%, and I don't know what the third one is. So, but that one is 10%. So now the performing loan, so increase in provisions on other assets or accounts receivable, increase in provisions on advances under finance lease, increase in provision for diminution in the value of investments, increase in provision for off-balance sheet engagements, provision for gratuity and unrealized exchange loss are all disallowable expenses. Hello, can you guys hear me?
Yes, sir.
Okay. So any question? That's all on transaction of banks. Any question before we move on? Any questions? No question.
No question.
Okay, no question. Okay. Then we move to taxation of insurance companies. Please be active. Be active. So Mary, can you please read what is on the screen? Oh, sorry, Ogineshuko. Can you please read what is on the screen?
The taxation of insurance business is covered by Section 14 of Company Income Tax Act 2004. The section deals with both Nigerian and non-Nigerian insurance businesses. It further distinguishes between life assurance business and non-life insurance business.
So if you are asked in your exam that what section of CITA talks about the taxation of insurance business, what will be your response?
Section 16.
Section 16 of CITA. Oh, yeah, continue.
For tax purposes, the main difference between the taxation of life assurance business and non-life business is that for life assurance business, the premium received from the assured does not form part of income for tax purposes, since the assured will definitely be paid or indemnified either at his death or the attainment of a specified age under endowment policy.
So now, this paragraph is telling us one, we have two types of insurance business, right? We have the life assurance business and we have the non-life insurance business. So now this paragraph is distinguishing between the two. So, and the main difference is that for the life assurance business, the premium received from the assured does not form part of the income. Why? Because, you know, either at his death or at the attainment of a specified age, maybe for instance, in the endowment policy, what they have there is 70 years. So if by God's grace, the person lives more than 70 years, okay, so it means that he has to what? He has to redeem his what? His premium. Abi, he has to redeem his premium. And of course, the money is going back to him. Abi, the money is what? The money is going back to him. So that's why it will not form part of the income, because it is guaranteed, Abi, on the occurrence of a certain event, which could be what? Which could be death or what? Or attainment of the specified age. So since the premium is not taken as income, claims paid is also not what? Is also not allowable as a deduction for life assurance business. Okay, so the reverse is applicable for non-life insurance business. So meaning that at first, when the money, you know, is received, when the premium is received, it will not be considered as income. So at death or at attainment of that specified age, the claim the insurance company will also be paying to the beneficiary. We also what? To the policyholder, we also not, you know, be allowed as a deduction in arriving at the company's, you know, taxable profit. So let's look at some definition of terms. We have investment income. These as defined by section 16, subsection 6. For the purpose of taxation of the life insurance company, investment income means income derived from investment of shareholders' funds. Income derived from what? Income derived from investment of shareholders' funds. So, you know, we've just mentioned that the premium paid by the policyholder cannot be taken as the income for the life insurance business. So what then should, you know, be part of their income? Investment income, you know, is part of their income. So this investment income is the money of the shareholders that they use to invest either in another insurance company or in another portfolio. Do you understand? Hello? Hello? Hello, I do not understand, or I understand. So then for, okay, so that's for section 16, subsection 6. Then we have section 1 of section 16. Okay, so I've mentioned that we have two types of insurance business, the general insurance and the life insurance. So for the general insurance, it could be mutual, you know, other than the life insurance company. Then for the life insurance company, that's in line with section 13 of CETA. So profit on which tax may be imposed for an insurance business shall be in accordance with what is section 13 of what of CETA, section 13 of CETA. So then we have the section 16 subsection 13 defines gross investment, gross premium, defines gross premium and gross income as follows. So for the purpose of section 16 subsection 12, minimum tax computation, gross premium means the total premiums written, received, and receivable excluding unearned premium and premiums returned to the insured. Again, gross premium means the total premiums written, received, and receivable excluding unearned premium and premiums returned to the insured. So the gross premium probably, you know, is for the general insurance. General insurance, that is non-life insurance. But for the life insurance or assurance, you have the gross income, which means the total income earned by a life insurance business, including all investment income, but excluding frank investment income such as dividend income, and include fees, commission, and income from other assets, but excluding premium received and claims paid by the insurance. So the first one is for general insurance or non-life insurance, while gross income is for life insurance business or life assurance business. Hello, Shoye, is it understood?
Yes, sir.
Okay, please be taking note. Then we have minimum tax. So another thing you should note that the gross income may include other income such as annuities, commission received, rent, among others, as well as surplus arising from actuarial revaluation of the reserve for the unexpired weeks account. So other income for the purposes of non-life insurance businesses means all income of the non-life insurance business other than the gross premium and excluding frank investment income. So for the purpose of the minimum tax payable, Section 16, subsection 12 of CITA as amended provides that tax payable by any insurance company for any year of assessment shall not be less than 0.5% of the gross turnover, okay, or gross premium, for non-life insurance business, and 0.5% of gross income, okay, for life insurance businesses. Please take note. For life insurance business, is 0.5% of gross income, and for non-life insurance business, it is 0.5% of gross premium or gross turnover. Okay, so, and then note that for year of assessment or accounting periods between 1st January 2019 up to 31st December 2021, that is assessment year of between 2020 to 2022. Okay. So taxpayers are allowed, for 2 assessment years to reduce this rate to 0.25%. Remember I mentioned this was the class we had on last week Saturday. Okay, so that the minimum tax provision, because of COVID-19 in 2020 and the NSAS issues, so companies were granted a lot of incentives and the likes. So part of it is the reduction in the minimum tax rate from 0.5% to 0.25%. Please take note. And also, losses can be carried forward indefinitely for insurance companies. This as amended in line with Section 16, subsection 7 of CITA, in line with Section 16, subsection 7 of CITA. So another thing I want you to note is that Section 3 of the Company Income Tax ends Section 16, subsection 6, Section 16, subsection 3 rather, of CITA says that the profit on which tax may be imposed shall be the investment income less the management expenses, including commission, that is for life insurance business. For life insurance business, we mentioned that they will be charged on commission. They will be charged on commission. So, and because of this, the commission will in arriving at the taxable profit, okay, so it will be what the investment income less management expenses, including commission expenses. Are we together? So then also any amount distributed in any form as dividend from an actuarial evaluation of unexpired risks, or from any other evaluation shall be deemed to be part of the total profit of the company for tax purposes. Then section 16 subsection 5 of the company income tax also states that not more than 3 months after an actuarial evaluation of unexpired risks or any other evaluation has taken place, the company shall provide the tax authority with full particulars of the evaluation carried out, including a copy of the actuary's revaluation certificate, actuarial revaluation certificate. Okay, so okay, then other. You have a question? Is that Kenny? Okay, Nishiko, please speak loud. Or you can type your question. Hello. Okay, Nishiko. And Kendi, you are saying that you don't understand. Eh?
Understood, sir.
Okay. So other things to look at under the changes introduced by the Finance Act of 2019 and then 2020 and 2021 is the profit of which tax may be imposed for the general insurance. Profit of which tax may be imposed for general insurance. The profit shall be ascertained in accordance with the provision of subsection 2, as though the whole premium and investment incomes of the company were derived in Nigeria. So as though the unearned premium or the total premiums and investment income are derived in Nigeria. And if they were derived in Nigeria, what is the implication? They will be taxable. Okay, they will be taxable. Then, in line with section 16, subsection 8 of CETA as amended, any insurance company other than a life insurance company, any insurance company other than a life insurance company shall be allowed for deductions from its premium the following reserves for tax purposes. 1, reserve for unexpired risk calculated on a time apportionment basis of the risk accepted in the year instead of the old basis determined on a percentage consistently adopted by the company. And 2, outstanding claims and outgoings. So outstanding claims and outgoings shall also be allowed for deduction. An amount equal to the total estimated amount of all outstanding claims and outgoings, provided that any amounts not utilized towards settlement of claims and outgoings shall be added to the total profit of the following year, instead of the old provision, which was based on a percentage of 25% of total premium. So based on section 16, subsection 9 of CETA as amended, a life insurance business shall be allowed the following deductions from its investment income and other incomes. 1, an amount which makes a general reserve, and fund equal to the net liabilities policies in force at the time of actual evaluation. Then 2, all normal allowable business outgoings from its investment. So, and there will be no restriction of a certain percentage of 20% of gross income. So no restriction on 20% shall be available as total profit of the company for tax purposes. Then an amount which is equal to 1% of gross income, 1% of gross income, 1% of gross income, 1% of gross income, gross premium rather, 1% of gross premium. Okay, and or 10% of profits or 10% of profits, whichever is greater, to a special reserve fund and accommodation until it becomes the amount of statutory minimum paid up capital. Statutory minimum paid up capital. Then also we have section 16, subsection 12. Section 16, subsection 12. So in line with section 16, subsection 12 of CETA as amended, a insurance company shall be allowed the following deductions from its gross profit. A reinsurance business. So a reinsurance business shall be allowed the following deductions from its gross profit to be credited to a general reserve fund. 1, an amount not more than 50%, an amount not more than 50% of the gross profit, an amount not more than 50% of the gross profit of the reinsurer for the year where the general reserve fund is less than the statutory minimum authorized share capital. Okay, for the year where the general reserve fund is less than the initial statutory minimum authorized share capital. Minimum authorized share capital, or an amount not more than 25%, of the gross, of the gross profits of the reinsurer, for that year, where the fund is equal to or exceeds the initial statutory deductions, the initial statutory minimum authorized share capital. So that's all. So you can also go to you can check from page 60 from page 60 to, that should be 360, 363, from page 60 to 363 of your study test, okay, for more details on the recent changes, okay, on the recent changes introduced by the Finance Act of 2019, 2020, and 2021. Is that taken? Hello? Is that taken?
Yes, sir.
Okay. So we have additional information to be filed by insurance business. You know, I was saying the other time, insurance and the banks, okay, the banks do file the new list of new customers, every quarter to FIRS. So also for insurance company, okay, any insurance company that is engaged in the service of an insurance agent, a loss adjuster, an insurance broker shall include in its annual returns a schedule showing the names and addresses of insurance agents, a loss adjuster, and an insurance broker, the date their services were employed and terminated, and payments made to them, and payments made to, payments made to each of these agents, loss adjuster, insurance broker, for the period covered by the tax returns, for the period covered by the tax returns. So an insurance company is expected to maintain the details and schedule of policies, as well as risks accepted in a given year, and the computation of unexpired risks associated with them. So the schedule should comprise the name of the policy holder, type of policy, period of the policy, amount of the premium, and expired risk computed therefrom. So a schedule detailing the specific items making up the estimated amount of outstanding claims and outgoings shall be prepared by insurance companies. So again, a schedule detailing the specific items making up the estimated amount of outstanding claims and outgoings shall be prepared by insurance companies. And then insurance companies shall maintain a schedule of estimated claims and outgoings that constitutes the amount deducted every year. So section 16, subsection 5 of CETA as amended states that not more than 3 months after an actuarial revaluation of unexpired risks or any other revaluation has taken place, the company shall provide the service with full particulars of the revaluation carried out, including a copy of the actuary's revaluation certificate. I think I made mention of this the other time. So that's that. Then is that if we have an illustration, let's see. So yeah, who is reading? Who is reading now? Hello, are you there? Hello.
Yes, sir.
Yeah, read now.
Illustration. An extract of the returns filed by Apple Insurance PLC, a company engaged in non-life business for 2021 and 2022 assessing year. You guys read the following. Assessment year. Reserve for expired risks brought forward, 50,000 and 43,000. Reserve for non-expired risks carried forward, 65,000 for 2022 and 50,000 for 2021. Estimated claims and outgoing, 4,200 and 3,000. Actual claims and outgoing for the year, 2,500 and 2,800. Net profit before claims, 12,000 and 11,000. Total premium written, 125,150. And for 2021, 122,000. Then premium paid on reinsurance, 11,400. And for 2021, 11,200. Premium return to insured, 8,200. And for 2021, 7,100.
Mariana. Mary.
Okay, required. Compute the following for 2021 and 2022 assessment year. A, the unexpired risks that is attributable to the risks accepted in each year. Then B, assessable profits. C, the gross premium liable to minimum tax.
Okay, so to start with, we have to compute the unexpired risk that is attributable to the risks accepted in the year. So, and from the question, what are the unexpired risks that is attributable to the risks for the year? So, to get that, we have brought forward and we have carried forward, Abby. So, the difference between the two should give us the the unexpired risk that is attributable to the risks accepted in this year, isn't it?
Yes, sir.
So yeah, what is the name of the company?
Apple Insurance
Apple
PLC.
Insurance PLC. So what are we asked to do? A, computation
No problem.
of computation of unexpired rates that is attributable, computation of unexpired rate that is attributable to the risk that is attributable to the risk accepted in the year, that is attributable to the risk accepted in the year. So how many years do we have? We have 2020, 2021 and 2022 assessment years. So we have 2022, we have 2021 assessment year. 2022, 2020. So yeah. So what's our reserve for unexpired? You guys have the slides with you now. Yeah, use your slides. So we have reserve for unexpired risk carry forward. So what's the for 2022? What's the reserve of unexpired risk carry forward?
60,000, I think.
Is it 60,000?
Yeah, I think so. Yes, I can't see, sir.
It's 65,000.
Okay, 65.
And this one 50,000. You guys should use your slide now. Use your material. 65,000 and 50,000. Then the reserve for unexpired risks brought forward is that much. For 20, this one is even straightforward. Whatever that is carried forward there will be brought forward there. 50,000 naira. Abby? 50,000 naira. Then for 2022, how much do we have?
15,000.
For 2021, what's the reserve for unexpired risk brought forward? Eh?
43,000.
43,000. So what's the difference? 7,000 naira. Unexpired that is attributable to the risk accepted in the year. Risk accepted in the year. So that's for A. Then B, what I have to do, we have to compute the accessible profit. So we have to compute the accessible profit. So we have estimated claims and outgoings. We have actual claims and outgoings. And we have our net profit before claims, total premium rating, premium paid on insurance, and premium returns to insured. So B, computation of accessible profit. Computation of accessible profit. So let's start with 2022 or 2021 rather. 2021. So 2021 year of assessment. Please do not abbreviate your exam or write them in full. Whatever you are writing your exam script, write it in full. So we have net profit. Remember, we compute our adjusted profit, adjusted profit. So you bring net profit. The net profit before claims is like the net profit as per account. So what is our net profit before claims? 11,000 naira, 11 million naira. We have 11.
Yes, sir.
Hmm?
Yes, sir.
Okay, so let's the claims and outgoings here. Actual claims and outgoings for the year. So we have to deduct it from the net profit. Okay. So next, actual claims and outgoings. How much? That's 2.8. Then also we deduct estimated claims and outgoings, estimated claims and outgoings. So that's 3,000. In total, we have 5,008. If you deduct 5,800 from 11,000, how much do we have? 5,000 minus 11,000, I have 6,000. 6,000 minus 800, I have 5,200. So our assessable profit for 2021 year of assessment. Assessable profit for 2021 year of assessment is 5,200. Then for 2022 year of assessment, so our net profit is what? How much is our net profit before claims? Net profit before claims. We are talking now. Net profit before claims. So, hey, where are you guys now? 12 million naira. Abby? You have 12 million naira. Then our estimated claims and outgoings, we have 42 and 25. Hello, can you guys hear me? Yes.
Yes, sir.
Oh yeah, what's our actual claims and outgoings? Oh yeah, figure me now.
Sir?
What's the figure for actual claims and estimated claims?
For 2022,
Yes, ma'am.
actual claims is 2,500.
Uh-huh.
Then estimated claims is 4,200.
Mm-hmm. Yeah, we add these two together and call 700, 67. So if you deduct 67 plus from 12,000, what do you have? 6,000 minus 12,000, I have 6,000 left. 6,000 minus 7,000, I have 5,000 left. Have you now? You guys should talk now. Punch your calculator. Is it 5,000 or 80? Oh, there is something we should. You see this uh the estimated claims and outgoings. The estimated claims and outgoings for the previous year. Okay. The estimated claims and outgoings for the previous year will be an income in the current year. Okay. The estimated claims and outgoings for the prior year, that is the year before, will be an income, okay, for the current year. So there is an error. So after the net profit before claims, so we need to add estimated claims. Let me just rub it. So sorry, 2022 year of assessment. So we have net profit before claims. So then we add estimated claims and outgoings, add estimated claims and outgoings 2021. So how much is it? 3,000, Abby. So this will give us 15,000. Then less or deduct actual claims and outgoings, estimated claims and outgoings, estimated claims and outgoings 2022. So this one is, how much do you call this one? Eh?
So, is it only the estimated claims we're adding? Is it only the estimated claims we're adding?
Yes. It's only the estimated claim.
For that 2021?
Yes. So the estimated claim and outgoings for the previous year will form part of the income for the current year. Is that it?
Yes, sir.
So yeah, deduct 67 plus from 15,000. What do we have? 83. Have you?
Yes, sir.
So that's our assessable profit. Assessable profit 8,300 for the second year. Then see what I will have to do is see the gross premium liable to tax. Gross premium liable to minimum tax. See computation of gross premium liable to minimum tax. Liable to minimum tax. So we have for 2022, we have for 2021. 2022 and then 2021. Is Kende back? Kende, are you there?
No, she's not back, sir.
Okay. So we have total premium. So in our question, what are the items we are looking for? So we are making use of total premium rating. Okay, we are using total premium rating. Then we deduct the premium paid on reinsurance and then premium returned to insured. Premium returned to insured. So we are not touching premium paid on reinsurance. So we will only be taking the premium paid, premium returned to insured. So total premium rating, total premium rating. So our total premium rating is 125, 125, 150, and 122,000. 125,
150.
150, and 122,000. Less
Premium return to
premium
insured.
returned, less premium returned to insured. What was our premium return to insured?
For 2022, 1,200.
Yeah, for 2021,
7,100.
so yeah, what do we have?
For 2022, we have 116,950.
For this one,
We have
so
114,900. 114,900.
So our gross premium liable to minimum tax. Gross premium liable to minimum tax is 116,950. So therefore, our minimum tax based on gross premium. Our minimum tax based on gross premium 0.25% of gross premium is what? So yeah, for 2022, we have
For 2021,
we have 116,950 multiplied by 0.25. Abi? And for 2021 year of assessment, we have 114,900 multiplied by 0.25%. So what do we have?
for 2021, we have 287.25.
For 2022,
Incoming, sir. 0.25. We have 292.40. 292.40. 40 rather, sorry, 40.
are you sure?
Sorry, 292.38.
Abi?
Yes, 292.375.
Okay. So that's all on this illustration. So let's move on. Let's look at some other formats Let's look at other formats. So, determination of assessable profit and tax liability for a life insurance business. Determination of assessable profit and tax liability for a life insurance business. So the first thing for a Nigerian company, remember we have two types of company. We have Nigerian company. Have you now? So for the Nigerian company, the assessable profit and tax liability of a Nigerian company carrying on life insurance business is determined as follows. So we have the life insurance business for a Nigerian company. The thing needs to consider, remember we mentioned that gross premium will not be considered since since it will expire either at death or what, at the attainment of a certain age, okay, as specified under the policy. And because of that, the claim is also what is also not allowable, okay. So now, it is only investment income that we have. Then you can add other income such as fees and commission income. Fees and commission income. Then dividend from actuarial evaluation of unexpired leaves or other distributions. Then you arrive at the gross income. So arrive at the gross income. Thereafter, you can deduct general reserves. You had life fund account. Restricted to amounts equal to net liabilities of policies in force at time of actuarial valuation. Then you take the special reserve, which is the higher of 1% of gross premium or 10% of net profit. The special reserves again is higher of 1% of gross premium or 10% of net profit. So if it is the 10% of the net profit that is higher, you pick the 10%. Then for all allowable business expenses, you deduct all allowable business expenses such as rent, repairs and maintenance, and nights. Okay. So after deducting that, you arrive at your assessable profit. Then you can bring in your capital allowance. If you have unrelieved losses brought forward, okay? If you have unrelieved losses brought forward, you can bring that too. Then you bring in your capital allowance to arrive at the total profit or chargeable income. So the tax payable shall be the higher of tax at the specified rate. So if the total gross income for the year is 100 million naira, so what would be the specified tax rate? What would be the applicable tax rate? Hello, if the gross income or gross turnover is 100 million naira and above, what would be the tax rate? Mary, talk now.
0.5.
No, 0.5 is wow. The tax rate now, the applicable tax rate, when the turnover of a company, the gross income of the company is more than 100 million naira.
Oh, 30%, sir.
Oh, 30%. What if it is between 25 million naira and 100 million naira? What's the rate?
20%.
20%. And what if it is between 0 naira and 25 million naira?
Nothing. They will be based on minimum tax. So.
No, there will be no minimum tax.
Okay.
Auntie Mary.
Sorry, sir.
Yeah, please. So, just like every other company too, you have to compare based on the normal basis, Abi, based on the normal basis and what? And any other basis, which minimum tax, minimum tax basis is also part of. Okay, so using the normal basis is the 30% and 20% of the thing. Okay, or 0%, depending on the gross income of the company. Then you compare with the minimum tax. And we said that the tax authority usually go for the one that is higher, Abi, of all the basis of assessment, isn't it? Hello, is that true? Mary, is that
Hello,
true?
sir. I didn't hear what you said.
I said just like we used to compute for every other company. You compute based on the normal basis than any other basis. So for insurance basis and for insurance business, you compute using the specified tax rate, which is the normal basis, and compare with the minimum tax, which is 0.5% of gross income. Then you go for whichever is higher, isn't it?
Yes, sir.
So then let's look at for the non-Nigerian company. Computation of accessible profit and tax liability for non-Nigerian company in life insurance business. The accessible profit of a non-Nigerian company carrying on life insurance business is determined as follows. Investment income. Now, to compute the investment income, you have to do your calculation, just like we have for taxation of airline companies. Okay, but a little different. What you are looking at here is the premium received in Nigeria. Okay, so because you are only subjecting them to tax on the income they derived from Nigeria, isn't it? Income they derived from Nigeria. So the premium received in Nigeria divided by the global premium of the company, okay, divided by their global premium, multiplied by their global investment income. So that's how you get their investment income. You want to apportion. Okay, so you are operating. So based on the income they receive in Nigeria, which is the premium divided by the global premium, multiplied by the global investment income. That's how you get the investment income attributable to Nigerian operations. Then you deduct agency commission. You deduct agency commission in Nigeria, then allowable expenses in Nigeria, and then fair proportion of head office expenses. Then you arrive at the accessible profit. You arrive at the accessible profit. So another thing you should note is that for the Nigerian company, annual transfer to special reserve will depend on whether the total reserve is, equal to or higher than the minimum statutory paid up capital. Okay. Then also the minimum tax, on gross income was reduced to 0.25%, And as you can see, in our just concluded illustration, we use 0.25%. Why? Because the year of assessment is still between 2022 and 2021, just for 2 years. So the minimum tax was reduced to 0.25% on gross income for tax returns prepared and filed for any year of assessment fully due on any date between 1st January 2020 and 31st December 2021. 31st December 2021. So both days inclusive. So, and this is based on the Finance Act of 2020. So the Finance Act of 2021, okay, now reviews this and extended to up to 31st December 2022. Extended to 31st December 2022, but only for 2 assessment years. So if a company has claimed 0.25% for 2020 year of assessment and 2021 year of assessment, then it will not have the opportunity to enjoy for 2022 because it has enjoyed for 2 years already. But if the company missed 2020 and now is enjoying it. Will enjoy for 2021 and 2022, just like we have it here. So we did for 2021 and 2022. So I hope you understand. Is it understood? Hello,
Yes,
is it
sir.
understood? Okay, then for non-life insurance business, so the one we just discuss is for the life insurance business, both for Nigerian company and non-Nigerian company. And for the non-life insurance business, for Nigerian company, the assessable profit and tax liability of a Nigerian company carrying on non-life insurance business is determined as follows. Gross premium, less premium returned on cancelled policies, less premium returned on cancelled policies. Then we have our net premium. So remember what we did here now. So we have our total premium written and we deduct premium returned to the insured, premium returned to the insured. So then you add investment income, fees and commission income, rent received, estimated insurance claims for previous year. For example, insurance claims. Okay, so then what else? That's all. So the addition of all these items will give us what? Will give us our gross income. Give us our gross income. So our gross income, you less non-taxable income, if any, less non-taxable income, if any, then you arrive at what? You arrive at the net income. You arrive at the net income. Thereafter, you deduct reserves for unexpired risk calculated on time apportionment basis, then insurance premium paid, commission paid, other life management expenses, and other life management expenses. There also, you bring in insurance claims and outgoings, actual total claims expenses, Then you add estimated total claims expenses. You add estimated total claims expenses. You add estimated total claims expenses. So remember what we did here now. Abi, Mary, can you still remember? Can you see it?
Yes, sir.
And in the previous year, in the following year, what did we do? What did we do? So we added
actual and
estimated claims and outgoings. Abi?
for 2021. Yes, sir.
So that's what we have in this format as well. Okay, so remember to arrive at our gross income, we have added the estimated insurance claims for previous year, Abi. So here we are deducting the expenses. So in the following year, these estimated claims will be considered as what? Will be considered as income because it is an estimate. You understand? It's an estimate. So also total claims and outgoings claimable A plus B. We have this. Then we arrive at our assessable profit. So if you have any loss, brought forward, you deduct this loss balancing charge. If you have any capital allowance, okay, you deduct capital allowance too to arrive at the total profit. So then to get your tax liability, you do the higher of tax at the specified rate. So if the company's gross income is say maybe 120 million naira, So what will be our tax rate? Our specified tax rate will be what? Mary. Our specified tax rate will be what? Hello, Mary. Are you there? Can you hear me?
Yes, sir.
What will be our specified tax rate?
30%.
30%. So then taking into consideration the gross premium or tax on 0.5% of gross premium. So if you do the tax on the 0.5% of gross premium, you compare it with the 30% of the total profit, then whichever is higher is the one you recommend for the tax authority to assess the taxpayer, or you recommend for the taxpayer to pay to the tax authority. Then for the non-life, you see under the non-life business, any unutilized part of both the actual and the estimated claims and outgoing expenses in any year shall be added back to the profit of the following year. You've taken this. So for the non-Nigerian company under the life insurance, under the non-life business, where a non-Nigerian company is engaged in non-life insurance business in Nigeria, the assessable profit will be determined just like that of the Nigerian company, just like that of the Nigerian company. However, only premium received in Nigeria will be taken into consideration, and only expenses incurred in Nigeria will be allowed as deduction, including a fair proportion of head office expenses, So for a non-Nigerian insurance company to be liable to tax in Nigeria, it must have a permanent establishment in Nigeria. That is, it must have a branch or a subsidiary in Nigeria. So permanent establishment in relation to an insurance company means a branch, management, or a fixed place of business in Nigeria, but does not include an agency in Nigeria unless the agent has and habitually exercises a general authority to negotiate and conclude contracts on behalf of such company. So where an insurance company carries on a life class and a general class insurance, that is where a company is into both the non-life insurance and life assurance business. And the life assurance business, the funds and books of accounts of one class, that is either non-life insurance or the life assurance business, shall be kept separately from the other, as though one class does not relate to the other class, and the annual tax returns of the two classes of insurance business be made separately. So you cannot, consolidate the two businesses together. So you have to prepare the accounts separately, even though it is just a company. Okay, even though if it is just one company that is operating both, their financial statement has to be prepared separately because of the unique characteristics they both have. So where, for instance, or for each class of insurance business, where there are more than one type of insurance products in the same class, they form one type of business, and the loss of one shall be allowed against the income from another type of insurance business, but the loss shall be available to be carried forward against profit from the same class of insurance business, and such loss can be carried forward definitely effective February 1st, 2020. So if the company is into a non-life insurance business, such as motor insurance, theft, burglary and the like, so they will be taken as one product. Okay, so then we have reinsurance business. So the assessed profit and tax liability of a company carrying on reinsurance business is determined as follows. We have the gross premium, then we have premium returned on cancelled policies to arrive at the net premium. Then you add investment income, fees and commission income, rent received, estimated insurance claims for previous year, for instance, reinsurance claims. Then you arrive at the gross premium. You arrive at the gross premium, gross income. Okay, gross income. you arrive at the gross income. Then you deduct non-taxable income, if any, to arrive at the net income. Thereafter, you deduct reserve for unexpired rates calculated on time apportionment basis, your insurance premium paid, commission, other allowable management expenses, and actual total claims expenses and estimated total claims expenses. And estimated total claims expenses. Thereafter, you add transfer to general reserve, which is lower, okay? General reserve that is lesser than minimum authorized capital or 50% of gross profit, okay? Or general reserve that is greater, where the general reserve is less than minimum authorized capital. So what we are adding to the general reserve will be 50% of the gross profit. But where the general reserve is greater than the minimum authorized capital, then restrict to 25% of gross profit. Do you understand? So where the existing general reserve that you have is lesser than the minimum authorized capital, you transfer 50% of the gross profit to the general reserve. But where the general reserve is greater than or equals to minimum authorized capital, then what you are transferring to the general reserve will be restricted to 25% of the gross profits. Thereafter, you arrive at the accessible profits. You arrive at the accessible profits. Then if you have any loss brought forward, you deduct. And if you have any balancing charge, you add. Okay. Then if you have any capital allowance, you deduct to arrive at the total profit or chargeable profit. Then you apply your tax rates at the specified total at the specified rates, which could be 30%, 20%, or 0%, depending on the category the company falls in. Then you compare with the 0.5% of gross premium. And don't forget that the minimum tax of the 0.5% was reduced to 0.25% for tax returns prepared and filed for any year of assessment falling due on any date between 1st January 2020 and 31st December 2022. Okay, just for 2 assessments, 2 years of assessment. So you see that you enjoy for 2022 year of assessment and 2021 year of assessment, or 2021 year of assessment and 2022 year of assessment. I hope this is clear.
Yes, sir.
So under the insurance business, any unutilized part of both the estimated total claims and then actual claim, the estimated total claims and actual total claims expenses in any year shall be added back to the total profit of the following year. Are we together? Hello? Are we together? Any question?
No, sir. No questions, sir. Yeah, no questions, sir.
No question for now. So may I say we are done with the part 2? So we are done with the part 2. So should we start the part 3 now or maybe tomorrow? And Monday. Let me see if we can see. It's Monday.
Monday, sir. Monday.
Monday.
Yes, sir.
Okay. So I wish you guys best of luck in your coming exams. Thank you for coming to class today. In today's class, we have treated the taxation of banks, taxation of insurance, and taxation of insurance companies, taxation of banks, and taxation of insurance companies. Is it just Taxation of banks and insurance companies.
Yes.
Eh?
Yes.
Okay, so in our next class, we will be looking at the taxation of unit trust scheme, NITDA, among others. Okay, so thank you guys once again for joining me in class today. I wish you best of luck in your final exams. Thank you.